The Union Budget for 2022-23 has assumed 9.6% growth in gross tax revenue over the 24% increase in FY22. While this may look rather low, even with the 11.1% nominal GDP growth assumption for FY23, the government has factored in a dip in excise duty collections next year due to a reduction in duties on petrol and diesel. So taking out the excise duty, revenue growth comes to 14.2%, which according to Revenue Secretary Tarun Bajaj is a challenging task, especially after a high base of robust tax collections in FY22. Revenue collections also got a leg up in FY22 from around 70,000 crore rupees collected in capital gains tax, with about 20,000 investors entering the equity market every month and excess global liquidity pushing the Sensex to a record high. The Finance Ministry believes the good days are unlikely to be repeated in FY23, and this has been factored in the revenue expectations in the budget. While Finance Minister Nirmala Sitharaman was praised for the transparency in accounting in last year's budget as she included off-budget borrowings, the repeated failure to achieve the disinvestment target has been a sticking point. For FY23, the Finance Ministry has pegged its revenue estimate for disinvestments much more conservatively at 65,000 crore rupees, despite internal estimates by DIPAM suggesting the government might be able to garner 1.2 trillion next year. But what has spooked the bond market is the whopping 42.9% increase in gross borrowings estimated for FY23. The 10-year bond yields are inching closer to 7% thanks to the 14.95 trillion rupees gross borrowing target for next year. The high borrowing numbers make the rebalancing task of RBI more challenging as it slowly unwinds its accommodative policies. What has caused the government's higher dependence on market borrowings is its anticipation that collections through small savings schemes next year will drop to 4.2 trillion from 5.9 trillion rupees in FY22. The Finance Ministry believes less people will opt for small savings schemes as interest rates of traditional saving instruments go up with the tightening of the monetary policy. That would leave less elbow room for the government to finance its deficit from this head. However, the elephant in the room is the modest assumption for nominal GDP growth next year at 11.1%. Most analysts believe this is rather a conservative estimate. With inflation expected to remain stubborn next year due to rising commodity prices, a higher nominal GDP growth may make the Finance Ministry's job of overshooting the revenue collections target that much easier for one more year.
The debate around whether the revenue estimates are conservative can be looked at from three aspects. The first aspect is the GDP growth itself. Now, the nominal GDP growth has been assumed at 11.1%. Now, given the inflationary trends and the opening up of the economy, the nominal GDP looks to be conservative. The second one is the tax to GDP ratio. Now, the tax to GDP ratio in FY22, as per the revised estimates, has gone up by about 70 basis points. Now, the budget for FY23 has assumed the net tax to GDP ratio to go down by 20 basis points. Now, this seems a little conservative given the digitalization and formalization that we are having in the economy and the buoyancy that we have seen in GST owing to the tax efficiencies and the efficiency of administration. And we should be expecting about 1.4 to 1.5 trillion per month of revenues from GST in FY23. The third aspect is that whether the excise revenues from the excise duty on petroleum products will be realized in FY23 also. It was quite high in FY22. Now, given the oil prices are going to be up and there is a possibility that government may have to further rationalize the excise duty on petroleum products to manage the pump prices of oil. But given the opening of the economy and the larger consumption and the demand going up for oil and petroleum products, we should not have a much larger shortfall there. Now, given these three aspects, I believe that the revenue estimates are on the conservative side and the government will have the necessary fiscal ammunition from higher revenues to be able to deploy any needs for higher expenditure.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.